Good day after Super Bowl day. For those of you who joined me as Broncos fans, it's a day of, well, yesterday was actually the day of celebration, so maybe today's for many of you a day of recovery from the celebration, but still enjoying the after effects of the game. Dominated by the defense. Man. Anyhow, let's talk about finance a little bit here. We've got a couple things to talk about today. We're going to go over today's assignment, which is problems 2, 4, 7, 8, and 12 are this week's assignment for Chapter 6. So we will give that a look. Chapter 6, we start getting into some financing things and some interest and just looking at those in the basics, really. Obviously, this is something as a banker that I worked with often. And I love interest. That's how banks make money. We pay out a little bit of interest and charge people a little bit more interest and kind of take a little bit off the middle. It's a heck of a way to make money. But actually, and even though it almost sounds fraudulent, it's actually a very efficient system, and it works quite well. I'm not sure as a saver, for example, that I would want to by myself, go out and lend money directly to like startup businesses and those types of things. If I lent it to one and it went broke, then I would suffer the full consequences. But we deposit our money in a bank and get a little bit of a interest, heavy on the little bit at this point in time, but we get to dilute our risk a little bit, which is a key thing. So anyhow, I digress, talking a little bit about banking. Today's or this week's assignment, I don't think, I didn't find it terribly difficult. Hopefully you don't as well. But we go through it real quick like here. Again, you guys had problem 2, I think, 4, 7, 8, and 12. And so I did similar ones. I did number 1, which is much like your number 2. And it's Gary's Pipe and Steel Company expects sales next year to be $800,000 if the economy is strong, $500,000 if the economy is steady, and $350,000 if the economy is weak. And then Gary decides to apply some probabilities to that. And so 20% probability that the economy will be strong, and 50% probability of a steady economy, and a 30% probability of a weak economy. So what's the expected level of sales? So he's just plugging in different probabilities and different sales forecasts to give him a maybe a baseline or a a number that he wants to shoot for in terms of his projections, to budget around. Oftentimes you would do a worst case scenario and a best case scenario maybe, and then this might be a more of a midline, even though that's pretty close, and we'll find that it ends up being fairly close to that number anyhow. But again, this is just all about the setup, and then the math is relatively simple. But so I put in place strong, steady, and weak. Strong sales 800, steady 500, and weak 350,000. My probabilities, and again, I have to enter those as, make sure you enter these as, 0.20, okay? And then I converted it up to a percent by using this. Okay, then it's just a simple matter of saying, okay, make sure that adds up to 100, and it does, right? 100, or if I did the math and didn't have the percent, it would equal 1. Just to give you an idea there, if I took it out and just made this into a number, it'd be 1, okay? Anyhow, so the math is just simply then this. It's my probability times the level of sales, projected level of sales, given that outcome. 160, okay? I can, because it's going to stay, this is going to be 50% times that, 30% times that one. I can actually just grab that by the corner, drag it down. That copies that formula down. Okay, and then I just need to sum this, and that's what will give me my answer, my actual expected level of sales. So I like to use the auto sum up here. There's other ways you could do it. You can even type in equal sum and to do it in that fashion, and it'll get you there. So either way. And that gives me my answer, 515,000 for problem number 1. And your problem 2, again, is fairly similar. So and please go ahead and highlight your answer, making it a little bit easier for me. Problem number 3, and you guys have 4 if I remember right, and I think 4 is similar, yeah. So problem 3 says this: Tobin Supplies Company expects sales next year to be $500,000. Inventory and accounts receivable will increase by $90,000 to accommodate this sales level. The company has a steady profit margin of 12%. Okay, so that's profit on our sales, right? Or ROS, return on sales, is 12%, with a 40% dividend payout. Okay, how much external financing will Tobin Supplies Company have to seek? Okay, assume there's no increase in liabilities other than that which occur with the external financing. Okay, so a couple things that we need to look at here. First, we got our profit margin of 12%. And again, that's an ROS, or return on sales, is what our profit margin is synonymous with. And so that's saying that if we know what our sales number is and take that times 12%, we'll know what our profit is. And then it says, and here's a spot where you make sure you don't want to get confused, our payout ratio is 40%. Okay. What that means is that they're going to pay out 40% of profits. Okay, 40% of profits, not sales or anything like that, but it's 40% of the profits, okay, that they're going to pay out. Normally that would be after-tax profits, but this problem doesn't make any reference to tax or after-tax, and I don't think your guys' does either, no. Okay, so it's 40% of our profits that we're going to pay out in a dividend, okay? Then we're going to calculate our cash flow. So again, let's just set it up. Let's put in our sales. I put in a separate column here, kind of snuck one in there, and we narrow that up a little bit. We don't need it to be that wide. But so I got a profit margin, our dividend payouts 40%, our cash flow from operations. Okay, I call that, I guess, and my inventory and accounts receivable. That's the increase, right? That I'm going to have as a result of my sales increase. So, okay, or as a result of my sales. So, plug in my number. So 500,000 is my sales, and profit margin is 12%. So this is simply equal to. I'm just gonna hit some deletes along here, and then I'll walk you through it. So, okay, so this is equal to my profit margin, my 12%, times my sales. Hit my times, hit my sales. Okay, my dividend payout then is simply equal to 40% of my profit. Okay, yeah, I kind of got this labeled incorrectly. I'm doing it this way, I guess, because this says profit margin, which is the 12%, and this is not my profit margin. This is actually my profits. So forgive me for that a little bit. And if you do it as the same way, I'll be forgiving to you as well. Okay, the dividend payout then is simply equal to my 40% times my 60,000. Okay, but then my cash flow from operations, since this was my profit margin, this is how much I'm paying out in dividends. Okay, this is how much I'm paying out in dividends, and actually this might also be termed my retained earnings. Okay, this should be my after-tax money, and then this is what I'm paying out. So this is actually probably would be a better term for this. I'm going to even change that. How's that? Retained earnings. Okay, is profit minus my dividend payout. Okay, so in this case, it's going to be my equal to my 60,000 minus my 24,000. Hit my enter. Okay, there's my retained earnings. I have to invest, another $90,000. Okay. Or I'm sorry, I'm going to have an increase in inventories and accounts receivable of $90,000 to support that sales. So how much do I need? I'm going to need to borrow, right? I'm going to have to go to the bank and borrow some money. So I just enter this in as a negative 90,000. Okay. And by the way, again, you could enter it in. Let's see if I can do this. I've got it obviously fixed. But if you entered it in as a number, you know, it might be like that, and you could put in a decimal, okay, you know, or you can certainly come up and hit the dollar sign one if you want, and again, get rid of the decimals, and then it would enter it like that. I think the custom relates to whether or not I want the and accounting is a good choice there, because whether or not I want the parentheses to be around there. It could be entered as a minus, or it could be entered with parentheses, either one. In any event, this then, my financial needs equal to my retained earnings. I got to hit my plus sign in this case, right? Because that's a negative number, and that tells me that I'm going to need $54,000 in financing. All right, onward. Whew, this one's bigger. It's just definitely not any more complicated. It's just bigger. So, and this sample's like your samples 7 and 8, and so this is one that I did. It's a lot like 7, but it should allow you to get done with number 8 as well. And again, go through the process and set it up. But I use different numbers. Your guys's would be Boatler used Cadillac Company requires $850,000 in financing over the next couple of years. The firm can borrow the funds for 2 years at 12% interest per year. Mr. Boatler decides to do forecasting, predicts that if he utilizes short-term financing instead, he'll pay 7.75% interest in the first year and 13.55% interest in the second year. Determine the total 2-year interest cost under each plan, which plan is less costly. So I put in $500,000. Okay. So I just put in $500,000, and I said I used 5 1/4. I tried to get my interest rates a little closer to what normal would be right now, 7 and 13 and stuff. So a little bit out of whack. 7 might not be too far off, but so I said if I had a consistent rate of 5 1/4, how would that compare to instead a rate of 4 1/4 that would go up to 6 3/4? And again, I put my labels in year 1, year 2. My amounts, plug my interest rates in. Again, you have to enter that as 0.0525. Okay. And then to calculate just how much interest I'm going to pay, it's just my rate times my principal amount. So it's simply equal to this one times this one. Okay. 26.5, and because the references stay the same, again, I can just drag that down, okay, and then I can get a sum because I just want to know what that is, and I could also just go one plus the other. It would be the same. So okay, and but in my comparison, I'm going to say I got the same $500,000 both years, but I'm going to go from 4 1/4 up to 6 3/4. So again, I just enter my and 0.0675. Okay. You know, I can copy too. I can just hit that and hit that copy and then paste, and it's going to paste that formula. Okay. I can drag that formula down, put in my underline just because I like those, and then hit my sum again. Ooh. So I got an underline there, and I didn't want that, so I gotta get rid of that. No border. There we go. Okay, but then I want this to sum. Okay, so which one's cheaper? Right, based on my projections, then this one here is going to be cheaper. Okay. And I'll color it there. Okay, now your guys's I think was more of a 3-year thing, and so I did the same thing, and you set it up just the same way, right? You just have an extra year. So years 1, 2, and 3, I did 250,000, 6% versus 4.5, 7 1/4, 6.15. Again, I can simply put that this is equal to my interest rate times my principal amount. Boom. I can drag that down. Okay, gives me the same amount each year, and we'll put a bottom border on there someplace right there. This is my sum. There we go. Okay. And I can copy this down to here. Same thing, and then I can copy this one on down. And sum this, and in my second example, actually my second set would be a little bit cheaper. It's hardly different. Now, you know, and in the real world of finance, you might look at that and say, ooh, you know, it's a little bit of savings, $250. That doesn't automatically make this your choice. Okay, and the reason I would say that is simple. You're projecting that these are going to be the rates. You don't know. Okay, in this case, you can lock it in, right, for 3 years, and with a $250 variance over 3 years and that kind of money. Otherwise, you know, you might be inclined to still, you know, select the even rate. So, of course, that's not what your problem asks you. Your problem just asks you which is cheaper. So, or which it's not cheaper. Maybe I shouldn't call it cheaper. Makes me feel cheap. Maybe I should just call it least costly, I think is what it says. So least costly. Got to be politically correct, you know. Okay, onward. I did 12. It's much like your guys' is what, 14? Something like that. Oh, you guys had 12. So I did 12, which is the same, but I imagine that I used some different numbers. So, okay. And what this, it's Coulter Steel has 4.2 million in assets. It says short-term rates are 8%, long-term rates are 13%. Earnings before interest and taxes are $996,000. The tax rate is 40%. So EBIT 996, tax rate's 40%. If long-term financing is perfectly matched, synchronized with long-term needs, asset needs, and the same is true of short-term financing, what will earnings after taxes be? For a graphical example of perfectly matched plans, see figure 6.5. So figure 6.5, I was kind of looking at this a little bit earlier. I'll go back and find out which page it is for you. It is page number 169. Okay, 169. And then it's really, really important to look at the right-hand side there, and it tells you which part receives long-term financing and which part short-term financing. Okay, so it breaks it down, and it tells you that even permanent current assets would be financed over long-term financing. So again, I used a lot of different numbers, but I set it up like this. Okay, I think it's a good way you guys could look at setting it up. But you got your temporary current assets, your permanent current assets, and question might come up, what are permanent current assets? This is a good teaching moment, but that might, you know, a lot of companies that, especially after they've been in business for a while, they end up with pretty regular levels of, say, inventory and maybe accounts receivable, maybe especially accounts receivable. Sure, they might have some seasonal needs and other things that would create temporary current assets, but they've got some permanent current assets that, you know, they always have inventory of at least 50,000. They always have accounts receivable of at least 50,000. Okay, maybe during seasons those go up and down some, but you know, that's kind of the minimum, and so those could be financed on a permanent basis. And then fixed assets, we tend to always finance on a permanent basis. So I set it up just exactly like they did in the book, right? You got this set of numbers there, and you got your total. And then I used rates of 5, 7, and 7. Your guys' rates are something different, of course. And just calculated my interest just the exact way we have been, which is my rate times my principal amount. And I drag that down. Okay. And I sum that. You know, another question might be, you know, why would you, if this is, you know, if that's the higher rate, why would you fund that, you know, at the higher rate versus the lesser rate? Again, risk. Okay, you know, if you lock in the financing, you don't have to worry about the rate, but you also don't have to worry as much about the actual financing of those deals. You know, these ones probably get renewed. These types of loans here for a temporary current, they get renewed every year. Okay, and you got to go to the bank and, you know, and or sell bonds or whatever the case is, and you got to meet the requirements every single year. Whereas this one, then you're going to be locked in. You know, you might lock in the rate and the terms and everything else, and so there's some reasons for doing that, even though it might be a little bit higher rate. Okay, so then we have to go through and we have to put in. We have to calculate what our after-tax or what our net income is going to be. So in my case, I used an EBIT that I just made up of earnings before interest and taxes of $180,000. Okay, I've calculated what my interest expense is, so I can simply enter this in as a minus this number. So that's negative. So my earnings before taxes then is simply this minus this, but because that's a negative, I have to enter it, you know, the old oddball way. Equals my 180 plus my negative 76.5, so there's 103.5. Now my taxes, and taxes I used the same, I think 40% that you guys have, and I just put the rate here and there, I guess, but I put it over here so that I can make reference. So my taxes then are going to be equal to 40% of this amount, so equal to my 40% times my 103.5. So there's my taxes. Ooh, except for, you know what? I should have had that as a minus number, right? Okay, because taxes are negative. I can come up here and I can just simply change it up here, you know, kind of in my, I don't know if you could call that the address line or whatever the heck, but I can put my negative in, equals a negative. I can actually get rid of that equals and just have it as a negative, and that'll enter it in correctly. It will enter it into my worksheet correctly. How's that? Instead of entering it incorrect, oh, that doesn't sound right. So again, then I'm going to subtract my taxes from my earnings before taxes, and that'll give me my net income or earnings after taxes. And so this is simply equal to this one. And again, I'd have to hit my plus because it's a negative. There we go. 62,100. Your guys' numbers are obviously different, but set it up the same way, and you shouldn't have too many troubles getting that to work. So thanks. I think that's all I have for that assignment. Relatively, I think, easy one. That's good. We're coming up on some that are going to get a little bit more complicated, and I'm sure you'll enjoy them. They're a little more detailed. Thanks, and we'll send out another video a little later today on Project 1.